Everything I teach is built around one steady rhythm that we repeat every single paycheck. And that's park it, chunk it, spend it, repeat. The first step is park it. Parking your money means leaving income in your regular checking account for expenses paid from checking. This includes your mortgage or rent, utilities, insurance, auto drafts, any other credit cards that are coming up, any bills that cannot be paid with a credit card, along with a small buffer so you can breathe. These expenses stay exactly where they are. You continue paying them the same way you always have. Nothing changes here, and that's intentional. Stability comes first. We are not creating chaos. We are creating control. After these non-negotiable expenses are parked, whatever income remains becomes your chunk. This is the chunk it step. This is not extra money. It's the same money that would have been sitting in your checking account to cover groceries, gas, and household necessities anyway. Instead of leaving it there in that checking account, you are moving that chunk onto one primary credit card on payday. By doing this, you immediately lower the card's balance and thereby reduce the interest you're being charged. Credit card companies calculate interest based on your average daily balance. That means the longer a balance sits, the more interest quietly builds. When you make a large payment, that chunk at the beginning of your pay period, and you're going to do this every single paycheck, you are giving interest less time to work against you. And there's a benefit that's a real game changer. That chunk payment also satisfies the card's monthly minimum payment. You are not paying for groceries and gas and then also paying your monthly minimum. Your groceries, gas, and household essentials have just become your minimum payment. Hello, that's huge. Now, after you chunk, you move into the spend it phase. Throughout the pay period, you use that same card for any bill that can be paid with a credit card or any variable expenses between pay periods, like groceries, gas, if you need an oil change, miscellaneous, life happens stuff. For many people, this part feels uncomfortable at first. It feels backwards to use a credit card right after paying it down. That hesitation is completely normal, but this is not reckless spending. It is strategic spending. Because you prepaid those expenses, the balance was lowered first. Even though small charges are being added along the way, interest is actually calculated on that lower balance every single day. That is the advantage. You're not adding new debt. You are controlling existing debt more effectively. So here's a simple real-life example. Let's say you normally keep $1,000 in your checking account between paychecks to cover gas, groceries, and any household spending. On payday, instead of letting that $1,000 sit in your checking account, you just move it onto your primary credit card as a chunk payment. Let's assume for this example that you get paid every 2 weeks. You spend $800 walking that card back up. That's where you're putting your groceries on the card, you're putting your gas on the card, and any expenses you may have for this pay period. So what happens? The balance was dropped on your credit card by $1,000 immediately the day you paid the $1,000 chunk onto your credit card. Interest was then calculated on that lower balance every day of that period. And you ended up with $200 eliminated from your principal debt in just that pay period because you put the $1,000 on there, you spent back up $800. So now $200 is being applied directly to your principal, and your interest is being calculated on that average daily balance based off of when you hit that card with $1,000. And yeah, you're spending on it, but it's still lower than where it was. Not only from the chunk itself, but the immediate reduction in the daily interest calculation because of the chunk. That's the key. The frequent chunks hit your principal and your interest. If you had walked the card all the way back up to the 1,000, you would simply be maintaining the same balance, the same debt. It wouldn't be growing, but it wouldn't be shrinking either. The final step is repeat. Repeat does not mean every pay period looks the same, and it does not mean the unexpected won't happen. Life will happen, and that's not a failure of the system. Repeat simply means when the next paycheck arrives, you return to the same steady rhythm. You park what must be paid from checking, you chunk what's left onto the card, you spend from the card with awareness, and then on the next payday, you repeat. Awareness means you stay conscious of what's happening instead of going on autopilot. When an unplanned expense shows up, notice it. Don't panic, and don't pretend it didn't happen. You finish the pay period, adjust if needed, and come back to the rhythm again. Some pay periods, your chunk will be smaller. Some months, the balance won't move much at all. That doesn't mean this isn't working. Progress with velocity banking comes from consistency, not intensity. Repeat is where this stops being a strategy and starts becoming a habit you can rely on.